Expectations have changed dramatically, haven't they?
Absolutely.
I mean, it was only 6 weeks or so ago, going into the September meeting, that investors expected the Fed to cut their asset purchases by 10 to 15 billion per month. And going into this meeting, no one's really expecting that at all. And really, the consensus is now expecting the first taper at the end of the first quarter of next year, so March 2014. And we've seen that reflected in interest rates. So interest rates have come down a lot as investors have reset expectations for tapering. And as Janet Yellen has now been nominated by the president to be the next chairman of the FOMC. So what we do for bond portfolios here to protect against the renewed fears of taper in the future is look for cheap ways to find insurance against rising interest rates, whether those be through floating rate securities, shorter durated instruments, or simply through options when interest rate volatility is actually very low right now.
So are you staying on the shorter side then, and will for a couple of months?
Well, as we look at, for example, the 10-year Treasury, we think fair value for the 10-year Treasury is in the 265 to 290 range. Mm-hmm. That's based on our expectation of the forward path of Fed funds, mm-hmm. as well as what we think is a fair risk premium or a term premium that investors should be paid for taking duration risk. When we look at the 10-year Treasury today at about 2.5%, we'd prefer to shade our maturities a little bit shorter. Looking at the front end of the yield curve, kind of into 0 to 5 years or so, appears about fairly valued. The Fed gave us their summary of economic projections at the last FOMC meeting in September, and they said at the end of 2015 they expect the Fed funds rate to be about 1%, and at the end of 2016 they expect it to be about 2%. Those interest rates are fairly priced into the front end of the yield curve now, so we feel fairly comfortable with shorter durated instruments.